Headline. Let's kick off this morning with Dr. Rad Al Kadiri, Managing Director, Energy, Climate and Resources for the Eurasia Group. Rad, news overnight that Russia has cut off or will cut off or is about to cut off Poland and Bulgaria for their gas access. Your thoughts on how big a step this is and where does it go from here?
A very significant step, Sean. I think, this is something that Russia has not done so far through the 9.5 weeks of this war. It's actually increased its supplies to Europe over that period of time, really reinforcing its position as a reliable supplier. As far as we can tell, so far, Russia is saying that this is the consequence of refusing to pay in rubles and refusing to meet its conditions and payment in rubles, and it's an escalatory step. It shows how serious Russia is about this rubles payment issue, how serious it is about maintaining its financial security, and obviously sort of increases the tension, increases the level of confrontation with Europe. The next step is Europe's to take, and the EU's is to take. The EU Commission has said there is a workaround for this that countries can actually use, that they can pay in euros and dollars, and that can be then transferred into rubles by within the EU about whether to take those steps, and Poland and Bulgaria have been amongst the most vociferous critics of those steps. The Bulgarians arguing that that was a breach of contract, and the Poles refusing altogether. I think also, Poland has obviously sort of been one of the more active, one of the more aggressive or hawkish members of the EU in terms of supporting the Ukrainian government. Has been very critical of the Russian government. You've just had significant arms purchases, and Poland itself has just put its own independent sanctions on Russia, including on Gazprom. So there's certainly a retaliatory measure that's involved here. But shows that Vladimir Putin is serious in terms of using the energy weapon if necessary, and it puts the EU and European states in a very difficult position. To accept ruble payments now would be to be seen to capitulate to the threat. It would certainly undermine the unity of the EU, and that has persisted until this moment in time. But also there are issues to do with energy prices and energy dependency that are taking time and will take time to shake off. So this is an escalatory step.
Let's welcome Rafiq Latta, Senior Correspondent for Energy Intelligence, sitting in the European Union in Cyprus, which I believe is still part of the European Union. Rafiq, the natural gas prices jumping 24%. Perhaps this was a preemptive strike by the Russians because there's been a significant amount of momentum, it would appear, including the Germans announcing overnight that they were just about ready to sign on to oil embargo against Russia, which of course is really the valuable cash cow for Moscow.
Yeah, well, two things I'd say to the earlier comment is you got the sense that maybe the Russians have just a bit late by a couple of weeks. If the war had started right in the middle of winter, they'd been in a bit stronger position. If they'd have done this with the Poles, gas demand's beginning to tail off. Maybe they kind of possibly missed a window for maximum impact. But yeah, I completely back Rad's words in that this is most definitely escalatory. What it comes down to at the end of the day, Putin cannot afford to lose this. That's the way he sees it, and he will do anything to ensure that. And there is only one way when you're in war, and that's to escalate, and that's the path we're on. So yeah, I would agree. This is escalatory. This clearly, for all the hits that Russia's taking in terms of volume, it's getting compensation and price. How much this will balance out in this particular with this particular move, I mean, is yet to be seen, but one would have thought it does. If the EU does an embargo, all I can say, it has to work, because if prices go substantially higher and by more so than the volume cut by the sanctions impacts, then Russia's going to win out. So it's playing the energy card from an energy dependent consumer perspective is highly risky. I personally believe the EU had no option but to go down this route to a certain extent, because otherwise it just wouldn't have been taken seriously. I think that's why Putin, in large part, made the move, the decision to invade, is that he believed that the EU would be toothless. And more than anything else, the energy moves the EU's made has shown that it is serious. But there's no doubt that it's just dangerous. And we're going to see the next few months are going to underline just how energy dependent and how this thing, how it works out.
Where does it go from here?
Yeah,
Malia Bengali, founder of MB Commodity Corner. Despite the drama, Malia, I mean, yesterday morning we woke up to the headline of the Russian foreign minister mentioning serious risk of this evolving into a nuclear conflict. Now we wake up this morning with Poland and Bulgaria, essentially 50 million Europeans cut off from their major gas source, and yet the markets oil's barely up 50 cents.
Thank you, Sean. Absolutely. I think the most important thing happening in the markets is the FX markets, the dollar. One of our biggest sort of catchphrases from last year has been, it's all been a macro trade. And when our clients ask what that means, is because liquidity has been a very powerful driving force for all asset classes since the last 2 years or for the last decade. We're in a position, taking a step back on the fundamentals. We know oil markets are tight and gas markets are tight, but we've had this wave of liquidity from the federal government from last year, and that's been withdrawn right now. US balance sheet is going to be going down. Fed is not able to support the markets via QE. The dollar is rallying aggressively. The yen is devaluing, and obviously the yuan is devaluing. What's happening in the FX market is a very sort of macro phenomena, and this devaluation is leading to a lower commodity prices. If you look at past historical crises back in 97 or 2001, the FX markets are called the liquidity trade, which obviously has a lot of liquidity risk unwind possibility in all these macro asset classes. And that's what's driving right now. Nobody knows how far the yen can collapse, but that's a big market. And if the money leaves the yen, obviously yuan will lose its competitive pricing power, and they are forced to devalue as well. So I think this is what's driving the markets right now. Is the macro markets are driving the markets more than the fundamentals bottoms up.
Dr. Rad, this is now, maybe obviously it was already, but perhaps profoundly so, now no longer a bilateral conflict between Ukraine and Russia, a bilateral war and invasion. Clearly, the Germans even announcing overnight that they were going to provide now tanks, that sort of escalation of heavy weaponry. So this is this gas move by Russia not in isolation of that sort of proxy escalation. Obviously, it's really about what happens next. I mean, when you take these two pieces, the soft side of the sanctions and this economic, and then the hard side in terms of weaponry and conflict, where do you see these two moving now after today's announcement?
Right, I think you hit the nail on the head, Sean. I mean, I think this isn't sort of happening in isolation, and I think from a Russian perspective, taking Rafiq's comment that Putin can't afford to lose. From a Russian perspective, the EU, NATO has been involved, directly in this fight for some period of time, and I think there was there was some seeming belief that you could put on sanctions and that you could tighten sanctions and increase the economic threat, the financial threat to Russia, and somehow Russia wouldn't see that as being sort of essentially allied with the Ukrainians and involved in this war. So I do think, this is a real reminder of, the potential for escalation. I think there's been a somewhat sanguine view that you can contain this crisis within Ukraine. Certainly, I think as Russian forces have, been redirected to the east, to the Donbass region, and the operation has been scaled down, certainly from sort of some of the very early goals that were announced by Russia. There's been some sense that this can be contained, that this can be sort of managed. And what Russia has done, I think, with the gas move, has been to sort of signal to the EU and signal to the world that no, it isn't simply going to play by the rules imposed on it. That it can take measures itself, and it has economic measures itself. And the energy weapon which it's now wielding has always been one that's sort of been in the background. There's been almost an assumption that if Europe carved out oil and gas, if oil and gas trade was allowed to move, then somehow the Russians wouldn't use it and wouldn't be retaliatory. That would be
and the Europeans, as you said earlier, did put a pretty strong signal over the weekend that there was a workaround on the ruble, and yet Moscow didn't seem to want to take that card.
Well, I think there's a couple of things. I think for Poland and Bulgaria, I would say they were outspoken. In terms of Poland, it's already said that by the end of the year it intended to cancel a contract. So, it's a convenient, those are both convenient targets for a shot across the bow. But I think this escalatory aspect, the fact that this war is expanding and that there will be a price to pay, the more that the EU and NATO engages in direct support for Ukraine, is where we're going. And a Russia that, as it is squeezed, is going to kick.
Yes. Rafiq, the strange thing about this story, strange, there's many elements to it, just from a technical point of view. Obviously, you turn off the pipeline that goes to Poland and to Bulgaria. And then strangely, as you mentioned, the timing of this whole event over the last 2 months, at the end of the European winter, we have Britain, news overnight that Britain now has a glut of gas and nowhere to store it. Can you tell us a little bit about where you see that structural issue going over the coming months? Because clearly we're now going into build up your storage as best you can ahead of next winter phase of the year.
Yeah, well, it basically comes down to one thing, and that's how long this conflict goes on for. If this conflict is around, you look at OPEC, and it doesn't say so, but it's actually got Russian production going up in Q4. So clearly, they are, for the purposes of public dissemination, assuming some sort of end in the next month or two. But if it goes on into winter, we're in a very serious situation, and I think it would behove the EU to start now, possibly yesterday, thinking about non-business as usual measures they can take. I mean, I was in Croatia just on holiday just now, and we had to open the window because the heating was on too strong, and that's probably Russian gas. There are things they can do, and they need to be doing it now. So everyone needs high stocks. Let's make that very clear.
Does Europe have the storage capacity? I mean, it's one of the big structural deficiencies in recent years. Is in the good times, nobody really built adequate storage.
They need to move to get anything they can, get any sort of incremental stuff going. In terms of accelerating FSRU capacity, but yeah, this is an issue, and they just need to build it as high as possible, and work on energy efficiency. I think is going to be a key point here.
Maliha, this escalation obviously brings the gas price substantially higher. Given that price point, how is that? I mean, are you going to buy lots of storage of gas when it's at these price levels? It's kind of like a catch-22 of sorts. How do you think this plays out vis-a-vis the gas demand and LNG in particular? There will be an increased competition, and there just isn't the LNG globally to meet this scale of 50 million people being cut off from gas from Russia.
You're absolutely right. I think the gas market is very precarious for the next 3 to 6 months and going into the winter, because there's a clear shortage problem, as you've highlighted right now. LNG flows are being rerouted. Obviously, a lot of US LNG cargoes are going to Europe to offset some of the Asian demand. But if you look at the pricing points between Asian LNG and US LNG and European LNG, there's a lot of arbitrage opportunities. So we think the European gas issue is going to be still very, very sort of risky and uncertain, debatable for the next few months. There is a problem. This is not like the oil market. The oil market has different sort of moving parts to it, but they're based on, if tomorrow Germany wakes up and says, guess what, we don't want to take Russian gas, which we don't think is going to happen, there's a lot of volatility in the near term going to summer, and storage is an issue. So the gas market, unfortunately, has a problem. Even the US gas market, based on the low domestic gas production prices, LNG rerouting, US has its own domestic gas needs right now. So the gas market is very, very volatile and very supportive, very different from the oil market. And I agree with you.
Malia, given the obviously the supply shortage issue that we're now, obviously gas is its own weaponize of gas, and where the Russian oil gets disrupted or not, so far that has not happened. But one of the things that seemed to be keeping oil prices relatively calm, if you call 100 and something calm, is China is every day also reporting a weaker and weaker outlook, a downgrade on its economic forecast. How do you see that playing out in China moving forward, given the COVID lockdowns and other issues at play? Stimulus announced yesterday seemed to reverse the decline in oil prices.
Absolutely. The talk that we had a few weeks ago, we discussed this very same issue. China's going through a slowdown. Their GDP numbers are nowhere close to 5%. We think they'll probably be 3 to 3.5% or even lower, and China's going through a massive demand destruction phase. Most of the analysts itself on the oil side have been very bullish on supply tightness, which we totally agree with, but no one's actually seeing how much demand destruction is taking place. And that's been one of our biggest theses into Q2 this year. Not only US and Europe is slowing down, China is massively slowing down. Look at the flight paths. There's no flight taking place, and that hits jet fuel demand. So that demand destruction, if you actually run into your numbers, that's a reason why the oil price is actually not rallying with all these sort of exogenous headlines on Russia and other things. The balance right now going to the market is you have a very tight product market with low distillate inventories and gasoline inventories, but then you have very weak demand coming in from Asia. So that balance is what's going to set the price going into the summer. But you are right, the sell side is not taking into account demand destruction coming in from the rest of the world, the global GDP impact to oil prices.
Rad, you mentioned earlier that Putin, and Rafiq mentioned too, cannot afford to lose this. But where is Europe and the US in that same posture? Can they afford to lose this? What's the problem in paying in rubles? I mean, it seems slightly semantics of sorts, although now, as you say, we would be conceding. But what's this stress on Europe and the US in the sense of being potential losers? Or is there a win-win out of this? Just that theme of lose and win.
I think it's increasingly difficult to see a win-win situation out of this, in the sense that, I think you had senior US officials in Kiev this week who essentially said that, what they would like to see is Russia lose this conflict, Russia be weakened significantly into the future, and Russia be unable, in a position where it's unable to actually revive a threat to any neighboring power for a considerable period to come. And that is essentially saying that you want Russia not only to capitulate, but you want Russia, a very weakened Russia, for a significant period of time. And I think that's contributed to some of the escalatory pressure that we've seen this week. And what we've seen from Moscow is in part a response to that. It goes back to Russia's fears that, fundamentally the effort has been for the past 30 years to weaken it and to isolate it, or at least to contain it, and refuse to accept its sphere of influence. Now, that's no justification for a war in Ukraine, but it goes to the mindset of Vladimir Putin. And if you take that on the one side, and then, really Russia's reshaping of its strategic goals in Ukraine, downgrading them again to the eastern part and the southern part of the country, but nonetheless, so saying that, it has an operational objective there. It's very difficult to see where you start peace negotiations right now and where you have an off-ramp for some of the escalation that you're seeing right now.
Should Europe, we asked the question a few weeks ago, who are the bigger winners of this, if there is such a word to use at this stage? But ultimately, you'd have to say the US isn't looking too bad at the top of that winners list at the moment. They've got their NATO 2% plus in terms of GDP. Exports of oil and gas coming out of the US are now in big demand. Should Europe be a little bit cautious about this robust posture of the US, given that clearly the Ukrainians cannot win this conflict?
I think what you're seeing from the Europeans all along has been a certain caution. And I think that underlies the sort of extent of the debate over energy carve-outs, how much pressure to put on Russia, what sort of elements to use, and different views in different capitals in Europe. There hasn't really been sort of one consistent view on some of these issues. So yes, I think you're seeing some of that. But as Russia continues, and as there's less sign that Russia is willing to step back, I think from a European perspective, there is a desire to weaken Russia and to ensure that this doesn't happen again. And that is, that's feeding this, it's feeding the escalatory ladder.
It's hard to know how you weaken a country that has 7,000 nuclear weapons. Let's go to the survey question today of where this goes next, I suppose. How will the rest of Europe react to Russia cutting off Poland and Bulgaria to gas? 1, do nothing. 2, impose an energy embargo on Russia, which has obviously been much talked about in recent weeks, or they just say put the hands up and pay in rubles, or none of the above. What does Europe do in reaction to this? Rafiq, in the midst of all of this, there is this thing called OPEC and OPEC Plus, which seems not so long ago the only gig in town, and now I'm not sure how relevant it is at this moment, but nonetheless, they are meeting again next week. And your thoughts, where's OPEC Plus at the moment? What's its role given the current sort of supply-demand global balance?
Yes, okay, so as far as next week's concerned, so we've seen the last few meetings with every indication possible that the market needs more oil. They did nothing. So I don't see now that we actually do have some indications, i.e. certain parts of the market have flipped into contango. We're seeing slight stock rise in the US. We've got the SPR release. I don't see them any change. They've got a very proud tradition of upending pre-meeting expectations, but this one will certainly be the biggest one in my 20 years of looking at this. So I really don't see any change in that in the short term. Structurally, I think OPEC, far from any sideshow, I think is really fundamental to this conflict. And I think something has changed in the last 6 months that is very important for consumers everywhere. Clearly, in its policy, OPEC has prioritized the Russian relationship and possibly energy transition concerns and the requirement to send a message there over its market balancing mission. And that should be a wake-up call for everyone. From its perspective, it's got to watch out that it doesn't drive energy security and the push for renewables and accelerate the transition with its recent policy. But it has clearly not indicated much concern over price pain, and I think that's going to be the bigger theme longer term and going through the summer. I think they're looking for some sort of renegotiation of how the transition plays out.
But on that point, you said post-summer, when do they start talking, Rafiq, about September? Because, of course, this agreement, this OPEC Plus pact expires in September.
I personally think we're going to see a crunch before then. I mean, it's getting to the point already. It's getting to the point where it cannot meet. Clearly, some members are just failing to meet by ridiculous amounts their targets, and I think that's going to show before then. But if not, I think they're going to come up with some alternative market management position mechanism in place. They've done that ever since OPEC Plus has started. They proved capable of doing it. They need to do it.
But it may require for it to be credible ultimately, which is so important in the OPEC Plus to be relevant. They need to be credible, and they may have to redistribute quotas in order to get there, which could be a very big hurdle. Malia, the other thing that's going to happen in the interim months, of course, is a series of quantitative tightening at the Fed in particular, with the first big rate hike next week. The US economy seems to be, I mean, of the three big pillars, China, you mentioned earlier, Europe clearly in a very stressed space. America is still a growth center, but nonetheless, the outlook there looks uncertain. Where do you think rates go? Where does the US economy go over the next 3 to 6 months?
We think the Fed's probably going to raise rates next week. There's talk about a 50 basis points to 75 basis points. We know the Fed has to raise rates. Whether they're aggressive or not, it's very hard to say, but they will definitely be hawkish. There's some sort of expectation in the market that they might be dovish given the market sell-off. We don't think that's going to happen. I mean, the S&P being down 7% does not preclude them to start, U-turning their policy. The balance
after it's gone up about 500%.
7% is nothing. Yes, technology stocks are now 40, 50%, but these are profitable, non-profitable companies. That's not the Fed takes and looks at. Their main measures, inflation. Inflation is very sticky right now. On the issue of balance sheet reduction, yes, they're going to let some of the assets roll off. So there'll be a quantitative tightening taking place. And that's about the liquidity we were talking about. That liquidity is coming out of the market, which is putting a lot of pressure on asset markets altogether. I think that's going to be the debate, how they're going to handle the issue of the dollar. Demand in the US is robust, but it is showing signs of plateauing. We saw the new sales data yesterday on the housing side. They were very, very weak. Fixed rate mortgages have doubled in the US. So there's a little pressure on the housing market. No one's talking about that. But there is, I mean, you've seen mortgages, the applications are going down right now. So the US is in a very precarious situation as well, because again, all these higher yields is biting the economy. The US consumer is trapped. They can't spend. The disposable incomes are lower. So how does that feed into GDP going forward? It's very negative.
On that point of the buy part, there's a certain debate going on that given the scale of debt since obviously over the last decade and the last period, that the Fed moving 1 to 2% could be enough to tip this whole thing over and knock inflation on its head. Others argue, no, this is such a scale, you've got to go to 4 or 5% perhaps to really get this under wraps. What's your view on the impact that a few 50 basis point hikes could have on turning this around, or being enough, if you like?
Sean, 50 basis points is nothing. If you take a look at the federal funds rate right now versus CPI, we should get something close to 4 to 5%, but we know the Fed's not going to get there. There's no way the system can handle that much rate increases. If you look at the past decade right now, every time the Fed has raised rates, something snaps. And that something snaps is what's happening right now. The Fed can only reverse their policy unless something collapses or inflation comes down. They very well know they can't raise rates. The system has too much debt. So they're hoping they're jawballing the market lower, hoping that asset prices collapse. And this demand destruction is actually helping their case in the long term, because as commodity prices come down or consumer inflation comes down, that will actually make their case a bit stronger. But right now, they have their hands tied, catch-22. They've got to raise rates and they've got a slowing economy. And that balance is very hard to manage right now. Something's got to give.
Let's get the survey result and give Rad the last word this morning. So this room thinks that 25% do nothing, a little bit more says embargo, 10% all pay in rubles, none of the above. Rad, your thoughts on what do you think is the likeliest outcome? And before you give us that, I would like you to pick up on Rafiq's comment there about OPEC and the Middle East countries seem to be prioritizing the relationship with OPEC plus, i.e. Russia, then US, Europe, and how deep there is a fracture there between the Gulf Arab OPEC states and their natural allies in the West.
There's a deep fracture, and I think this crisis has really sort of shone a light on it. But I think it's been a process that's been sort of ongoing for some time. To put it very sort of bluntly, I think the US security guarantee is not seen to be what it was, and I think events over the last few years have reiterated that. And, you know, combined with the fact that, you know, you are looking at Asian markets as being growth markets for the key commodities that the Gulf states export. But I think this is a real wake-up call in terms of, you know, whether the West is the natural ally moving forwards. And certainly sort of new leaderships in the Gulf states beginning to look at the world in a very different way and having sort of different reference points politically, security, economically, and otherwise in a different way. So I think that's sort of one of the big geopolitical shifts that have come out of this crisis, and it's worth looking at moving forwards. Question to be thrown out there, and I'm not sure I have an answer for it, is do we get into a situation where who you ally with starts to have an impact on a reputation impact on your commodities and your oil, and you know, whether the Gulf states are going to run into that risk moving forwards. In terms of what the EU will do, look, I think that the answers sort of are indicative of you know, the uncertainty that's out there and the lack of signals. But it's going to be very difficult, I think, for the EU to pay in rubles right now. I think this is, you know, this will be considered to be a red line by Europe cutting off supplies, and they'll react accordingly. And, you know, we go back to what's really been the theme of the discussion this morning in terms of this is, you know, no step is taken in isolation. And what we're having now is a set of steps that are driving us to a more confrontational relationship.
Do you think Germany gets on board with that? I mean, the DAX would indicate that the equity markets in Germany still don't see that level of stress.
I think the Germans will do that slowly. I think, you know, it depends what we think in terms of, you know, so you have two questions out there. Is Russia really willing to cut off all gas to Europe, including Germany? And the second thing is the EU and Germany in particular willing to cut off all gas from Russia? I think I would argue we're not quite at that step yet. That is an absolute break, but nonetheless, the risk is getting higher that we're moving in that direction, and markets need to start pricing that in.
Yes, they do. I would agree with that. We're going to have to wrap it up there. Every day is a drama. Let's see where it goes today as the markets digest this news, and particularly as the Europe and the US wake up. But as things stand at the moment, at least on oil, the outlook of the reaction in Asia is relatively muted on the oil price, at least, with Brent up 50 cents in trade today. Thank you, Rafiq. Really great to get your insights and have you on the show, and Rad as well. Thank you so much. And Malia, as always, your insights very much appreciated. Have a great day, everybody. We'll catch up every morning, 10:30 UAE time. All the best.
Take care.